Let's go ahead and launch this thing. Thanks for coming out and taking some time out of your day to participate in the webinar. We're going to try to help you prepare for an IPO. So today, to kick off, these are the folks that are panelists on the call today. Myself, John Morrison, Chris Arnold. He's one of our lead advisors on the wealth management side of SecFi. And then John Klingler is a financing specialist here at SecFi and works with folks seeking liquidity for their options and shares. So that's who you're talking to today. We're pretty knowledgeable about equity compensation, taxation, and how all that works together. So feel free to ask questions along the way. We hope that this is really helpful. It's intended to be beneficial to you. So yeah, don't hesitate to drop a question in the Q&A section, and we'll do our best to address it during the call or during the webinar. Right off the bat, we have to make some disclaimers. This is educational in nature. It's not meant to be a substitute for personalized advice from a professional. So take everything with a grain of salt and understand that this is educational in nature and just general. And everyone's situation can be quite different. So you really should think about these things in the context of all of the different things that impact your finances and your life. Okay, so who's SecFi? Well, we have a few different offerings. We have some DIY tools on our website that will help you understand the cost of exercising and the implications of exercising different types of options. So feel free to go to secfi.com, sign up, use those tools to your heart's content. We also do financial advisory and wealth management. That's the group that Chris and I focus on, and we help folks that are equity compensated to build their financial life and prepare for exits and manage their wealth going forward. And then we offer financing. And John, do you want to describe the financing for folks?
Yeah, absolutely. So in short, non-recourse financing, it's one of many paths that you maybe have to acquire your shares, but it's a way to acquire your ServiceTitan shares now so you can get ahead of option exercise taxes before the fair market value potentially rises. It allows you to then also start the clock on long-term capital gains so that you've owned these shares when you get to a future liquidity event. So SecFi provides us non-recourse financing to a few companies out there, and ServiceTitan being one of them. So yeah, happy to be chatting with all you folks today.
Awesome. Thanks, John. So first off, we got to just say congratulations. Like, going public is a rare event. Only 75% of VC-backed companies never even return capital at all to their initial investors, let alone reach an IPO. It's a very special event. It does not happen often. You should feel grateful. You should feel lucky. You should feel proud. And we can't say enough. Congratulations for participating in building something so successful that there are people clamoring to give you money to invest in the shares. That's a pretty rare sight. So especially in these markets these days where IPOs are few and far in between. So congratulations. When we look at the IPO timeline, you guys just filed your S1, I think Monday. So you're right here. I had you in rumors and speculation until Monday, and I moved the icon over to file S1. So this is where you are in the process. The S1 is otherwise known as the prospectus. It's basically, the seminal document that the SEC requires to disclose facts about the business to potential public shareholders. So it's a big deal. It is a very strong sign that an IPO is on its way. Usually there's a gap between the S1 and the roadshow. Can be weeks, can be months long, but the roadshow takes place before the initial public offering. And in the roadshow, what's happening is management of the company and their bankers are going around to big investors around the world and pitching the ServiceTitan story, pitching them on the equity. And those investors are placing indicative orders or indications of interest in how many shares they would like to buy at what price. And that is how a price eventually gets determined. The bankers and management go around the world talking to investors to figure out where is the demand, where is the supply, and they try to get to a price that balances supply and demand in a reasonable way. After, the roadshow takes a few weeks. Once they're done with the roadshow, they set the initial offering price, and that's the number that you see in the news often. It's like, oh, Reddit went public at $34 a share. That's the initial public offering price, and that's, that price that's determined in the roadshow process. A few hours later, generally, the shares start trading on the exchange. So it's not uncommon for the IPO to happen. You get the notification about the shares being offered at $34 a share or whatever the number happens to be. And then, 11 a.m. Eastern time, maybe it starts trading. It can depend on the exchange. Sometimes there's operational hiccups and it takes a little longer, a little shorter. So don't expect it to be immediate, like right when the market opens. It's very common that it doesn't start trading on the exchange until the middle of the day or so. And then most companies have a lockup on employee shares where insiders are not allowed to sell for around 180 days. It's usually a 6-month lockup, but that provision is really at the discretion of the company and the bankers. So pay attention to what they're telling you about what the terms are of your lockup before you're allowed to actually sell your shares on the exchange. I read your S1 and you guys are checking all the boxes for an IPO. So first thing I look at is the financial profile. You're growing, you're at scale, you're growing, roughly 30% year over year, got really strong gross margins and sticky revenue. The retention is high. Market conditions right now are pretty favorable. We're only a couple percentage points off of the all-time highs set just a few weeks ago. SaaS multiples are they came down during the 2022 timeframe. They haven't really rebounded all that much, but they're pretty much at pre-pandemic levels. And then you're operating in an industry with a lot of tailwinds. There's a professionalization of the trades is happening. There's a lot of roll-ups of small companies into bigger conglomerates, and they're going to need software to manage these integrations and roll-ups. You've got a strong management team with public company experience. Your investors are a who's who list, and you filed the S1, like I mentioned, on Monday. So all signs are pointing to an IPO is about to happen. Some risks that you face, the macro environment's always uncertain. There's competition out there, and you've been acquiring folks, and I assume that the street is gonna think of that as a bit of a risk. That integrating new companies is hard to do. So just a few risks out there that I see. I encourage you to go read the prospectus where it'll list even more risks in a lot of detail. But these are the top three that I came to as I was reading through the S1. All right, so you guys are all here probably because you have some equity options, RSUs, and the fact of the matter is it's really complicated. There's all sorts of terminology, and getting it wrong or messing it up can be pretty costly. So we hope that this is helpful, but please, again, seek some guidance, some professional guidance to help you with your specific situation so you can maximize this. I think, Chris, did you want to talk about assembling the team?
Yeah.
Why that's
So,
important?
so for, anytime that, we interact with folks that are, at the, onset of coming into, big sums of money, sometimes it's just, normal sums of money, like I think we really kind of think about this in three phases. The first is realizing the value from your equity. So up until this point, it's been private. Maybe there has been, some, a tender offer in the past, but otherwise it's been a stock certificate in Carta and ShareWorks, and really haven't been able to access this. So first is realizing the value of your ServiceTitan equity. Next is how do I actually grow my wealth going forward? And then ultimately, if I do come into money and this is a financial windfall for me and my family, how do I protect this? And I think, to help you with that, establishing a team of professional advisors can be really helpful, just to have someone who's objective and in your corner to help you navigate these things. So I thought it'd be helpful just to kind of highlight who are some of those members and what are their roles. I think first, to realize this, I think having, some help on the tax side and some help on the financial side, especially for, professionals that have been through this before with other folks. Instacart, Reddit, Klaviyo have been companies that, in recent years, it's been a pretty muted IPO market, but those have been, companies that have gone out. And so someone who's helped to an employee successfully navigate that, I think first and foremost, a financial and a tax advisor are going to be most helpful as you're trying to navigate, what's the difference between a cashless exercise and a, qualifying disposition? How much should I withhold for my RSUs? Those types of questions. And then ultimately, how does the equity fit within your broader financial picture? I think next up is as you think about growing the wealth, as you realize the proceeds, a financial advisor, a tax advisor are still going to be instrumental members of your team. I think you also want to think about, what is going to be a strategy to help grow this, and what are the appropriate risks that I'm taking, and am I compensated for taking those? And I think an investment advisor can also be helpful on that. Sometimes financial advisors and investment advisors are, one and the same. Other times you have someone that is more of a planner and really helps to the structure your financial situation. And then you have an investment expert as well. And then lastly, as you come into money, protecting that. So, in addition to the team members I've already mentioned, having some additional liability insurance coverage, and that can be sought out through a independent insurance broker. That's just if someone you were getting an auto accident, someone trips while they're visiting your house, they could realize, oh, you're a ServiceTitan employee. You've come into, a lump sum of money. We would want to come after that. And so having this liability protection can help to protect that in the event of a lawsuit. Also, being able to establish some estate documents can be the foundation for, families that have young children. And there could also be some additional asset protection for certain trusts that you would establish. And that would be an attorney who would help to draft those documents.
Awesome. Thanks, Chris. Yeah, it can be overwhelming, guys, but start the journey of 1,000 steps is you got to take that first step. So uh think about assembling a team of folks to help you. And generally people don't regret that. So how should you handle your equity? Well, there's a lot that goes into it. Today we're going to be focused on the dotted square here, the education. After this session, it's up to you to take the necessary steps to create a plan, execute the plan, and then monitor and adjust when you need to. A lot of times people come to us when it's too late, or not too late, but their delay or their procrastination limits the options that they have. So think about it now. Now is the time to be putting together your plan and thinking about how you might change it as circumstances change. Because once the stock is public and it's trading, your options can be more limited. So think about it now. All right, so let's get into the details of equity comp and how these things are taxed. How should you think about making some of the decisions that you're going to be faced? So we're going to start with different forms of equity comp. We're going to lead into taxes after that. We're going to talk about how to think about making a plan, and then we'll discuss the bigger picture of what a liquidity event like this can mean for your financial life. So with that, I'm going to turn it over to Chris and let him describe the different forms of equity comp here.
Thanks, John. So as John was saying, in order to make a plan, I think first we believe you got to be educated so that you can make informed decisions on, what to do with your equity and how this impacts your tax and your broader financial picture. So, most startup employees, the three most common types of equity that are granted are going to be incentive stock options or ISOs, non-qualified stock options or NSOs, and then restricted stock units or RSUs. RSUs are typically issued at more mature or later stage companies as the internal valuation has increased, just as a way to incentivize new employees that are coming on board, and also making sure that the exercise costs are not prohibitively expensive to buy the shares in the company. So, ServiceTitan, is a company that may have shifted over to issuing RSUs over recent years. I'll start with those. So when you're granted those, that is not a taxable event. However, the vesting date is going to be a taxable event. And most private companies issue what's known as a double trigger RSU. That simply just means that there are two events that have to be met before the RSUs are actually vested, and that becomes taxable. The first one is going to be a time-based vesting schedule. So that could be over a 4-year period. And then the second one is going to be event-based. And that is often an IPO, an acquisition event, when those units are actually vested. And at that point in time, the stock price on the vesting date times the number of units vested is going to be realized as ordinary income. So anyways, that's RSUs. The other form of equity is stock options. And at its core, a stock option is just the right to purchase shares at a fixed price in your company. So if you joined 5 years ago and your strike price was $5 a share, you could buy ServiceTitan stock at $5 no matter what the price does in the future. Now, the thing to be mindful of is as the price has risen and as that spread between your strike price and the fair market value gets to be wider, that's when tax implications can become a lot more meaningful, and something to be aware of. So incentive stock options, the type of tax it would be due on an exercise event would be known as AMT or alternative minimum tax. You do have the ability to exercise some ISOs every year without incurring any tax. So just buying the shares at the strike price. With non-qualified stock options, if there is any spread between the internal valuation, the fair market value, or also known as the 409A valuation for private companies, then you would have a tax liability. And that would be taxed at the same rate as your salary, as your commissions, as your bonus. So anyways, something to be mindful of. If you have NSOs, that is going to be income, and that presumably would be at a higher rate than what any kind of AMT would be costing you. So those are the three main forms, and then we can go into, what are the different types of tax that you may be incurring.
Quick question, Chris, that came
Yeah.
in. Someone asks, why would a company choose to offer NSOs versus ISOs and vice versa? I know one part of the answer, I'll give that, and you can give any other color. But one reason is by rule, you can only issue up to $100,000 of ISOs per year to an employee. So if your option grant, meaning the number of options times your strike price is greater than $100,000, then the remainder of your option grant has to be NSOs by rule. Chris, do you want to add on anything there about NSOs versus ISOs issuance?
Yeah. So in that point that John was making, that is the value that vests in a calendar year. So if it's vesting over a 4-year period and you are granted 400,000, you may still be underneath that, but it's the amount, the value, the strike price times the number of options that vest in a calendar year. If it exceeds 100,000, the excess is going to be treated as a non-qualified stock option. A couple other things. So ISOs can only be granted to U.S. Employees. That is just part of the US tax code. ISOs can only be granted to employees. So if there are any board of directors or advisors or even consultants or contractors, they could receive equity, but it cannot be issued in the form of an incentive stock option. And then also incentive stock options can only be, as I mentioned, for employees or within 90 days of terminating employment. Some companies do extend the window that employees would have to exercise, but after 90 days, those options would convert from an incentive stock option to a non-qualified stock option. So those are a couple of the reasons why. There's some other ones for early exercise, but I'll stick to those for most ServiceTitan folks. All right. So, we kind of ran through what are the types of options. I think now it's important to know what are the potential taxable events and then what type of tax might you owe. So, as you're vesting ISOs and NSOs, no taxes. Also, no taxes on the grant date. The two taxable events for incentive stock options and non-qualified are going to be on the exercise date and then on the sale date. Now, as I mentioned before, ISOs, you can exercise a certain amount of those every year and not incur any kind of tax. The larger the spread is between the company's fair market value and your strike price, the lower number of options you can get away with exercising without taking on any kind of tax. But that type of tax would be known as alternative minimum tax, and that's based off of the company's fair market value minus the strike price. On the other hand, NSOs, the fair market value minus the strike price would be subject to income tax on the exercise. And then it's important to note that with NSOs, only the sale price, if it's above the fair market value when you exercise, would be subject to a capital gain. Whereas on an ISO, if you satisfy a qualifying disposition, which means that you've held the shares for at least 1 year from the date of exercise and 2 years from the date that the option was granted to you, then the sale price minus the strike price would be taxed as a long-term capital gain. And you're also eligible to recover any kind of AMT that you previously paid in the form of a tax credit. Now that gets to be pretty nuanced. So I think that's another situation where a tax advisor or financial advisor to really hone in on run a projection of how much AMT would you recover. But you're able to get the AMT back. And the nice thing about ISOs is if you have a very low strike price and the company has grown significantly, that can be a pretty meaningful tax savings for you to have that full sale price minus the strike price as a lower preferred long-term capital gain. And then additionally, the RSUs, as I mentioned, on vesting, those are going to be taxed. Those are going to be subject to ordinary income. So that's going to show up on your pay stub. Most likely that's going to be on the IPO date at that initial offering price. And then the decision becomes, how much tax do I have withheld? We're going to get onto that on a subsequent slide. But because that is going to be realized as ordinary income, only if the price increases would you have a capital gain. And then it just becomes upon how long have you held the shares from the date of vesting. If you've held the shares for over 1 year from the IPO date, then any growth above the IPO price is going to be a long-term capital gain. If you sell it, immediately after the lockup period, that would be a short-term capital gain if the price has gone up. If the price has gone down from the IPO price, that would actually be a capital loss. And you're limited on how much capital loss you can use to offset ordinary income. So anyways, that's when we get into more of, okay, how much tax am I going to owe? What do I have withheld? Just so that there are no tax surprises, when you do file your tax return the following year.
I like to think about RSUs from this perspective. So instead of getting shares and being taxed on the value of those shares on IPO, what if the company gave you cash of the same amount? And then you turned around and bought shares of ServiceTitan. Those two scenarios are economically equivalent. Same thing. You still owe the same amount of taxes. You own the same amount of shares. So an RSU is essentially income. The amount of income that it generates is based on the price at which the company IPOs. And that is an economically identical situation to getting a bonus, taking that cash and buying shares. So if you're thinking about, how much should I sell or how much should I withhold? That's a perspective that might help you in that decision. Let's go ahead and talk about RSUs and give a bit more of an example here. Go ahead, Chris.
Yeah. So this is just a visual to really drive home the point that we were just saying. So let's say, you joined ServiceTitan 2 years ago and the fair market value when the RSUs were issued to you was $60 a share. Again, no taxable event. And if there's any growth in the price, you're going to be benefiting from that additional growth. So let's say this is hypothetical, but let's say ServiceTitan goes out at an $85 per share offering price. So again, $85 times the number of units that you have vested over the time period since you have been granted those RSUs is going to be income. So let's just say, this is an additional $300,000. That's going to be on top of what you've already made, throughout the year in salary and commissions. So you got to think of, okay, if my, normal year tax bracket, I'm in the 24% bracket. If I have an additional 300,000 of income, I'm most likely going to be in a much higher bracket. And that's where that tax deficit, because RSUs, the default withholding is going to be 22%. And so if you personally are in a higher tax bracket, that additional income may not have sufficient taxes withheld. But anyways, the IPO date is going to be taxed as ordinary income. And then let's say that ServiceTitan, does well, throughout the lockup period, and then, you sell it and it is at, $105 a share, or 115. Well, now you have an additional, $30 of capital gain on top of that. And again, if you've held those shares for over a year from the vesting date, that capital gain is going to be a long-term capital gain. If you sell it, within a 1-year period after the IPO date, it's going to be a short-term capital gain, and short-term capital gains are taxed at the same rate as your regular income is. So here we just have a visual to the point of, the default withholding for RSUs is 22%. Many companies will give you the ability to adjust that or elect for a higher withholding. And again, this is really where it comes down to your personal situation. It also comes down to kind of your risk, capacity, and kind of what your outlook is on the company. And so what you see here is, if the price, let's say it's the $85 a share is the IPO price in the example. If the price hovers, right around there, throughout the lockup period, and you're able to sell, at $85 a share, there's not too much risk because you could be able to liquidate it, and there's not going to be any capital gain. Again, the capital gain is only if it grows, the stock price increases above the price that it, vested at. But I think where, this graph is hopefully meant to be helpful is, if the price were to drop and you only have 22% withheld, and in my scenario, if you had an additional $300,000 of RSUs vest, then you might be in the 35% personal bracket, but then you have the ability to sell it at, call it $60 a share. Well, now the value's less, but you're still taxed on the value at $85 a share. And that's where you can get into, a real kind of tax dilemma. And that's not a favorable scenario that anyone wants to be in. And so the graph, it may look pretty small, but this is, to the tune of tens of thousands of dollars. Now, if the price goes well, then obviously withholding a smaller amount, you're going to benefit more from that growth. And then you could sell it, at a future date, and you've retained more of your ServiceTitan stock exposure. So there's not a right or a wrong decision here. But again, I think some of it is going to be dependent upon timing of when does the company go public. If they go public before the end of the year and you're subject to a 6-month lockup, again, you have a taxable event in 2024. Your 2024 tax return is due in April, and you may not be able to sell until June. And so that mismatch of timing could cause, either if you don't have enough withheld, you have to think about where am I going to come up with an alternative source of funds to pay my tax by the tax deadline. So anyways, things just to put on your radar for upcoming decisions. But I think just be mindful that the default withholding may not be sufficient for your personal tax situation. Okay, so we talked about a couple different types of tax: income tax, short-term, long-term capital gains, and alternative minimum tax. Why does all this matter? Well, they're not all at the same rate, and it varies based off of where you live. So income tax, has the biggest range. The lowest income rate is going to be 10%. The highest is going to be 37%. Whereas long-term capital gains, it ranges from 0 to 20. So anyways, that's where we say, if you meet certain criteria with your ISOs or even with NSOs, that in holding the shares for at least over a year from the data exercise, you could get more of that growth at presumably a lower long-term capital gains tax rate. The other thing I'll highlight on this page is alternative minimum tax. So you'll see it right in the middle there. So on a federal scale, there's only 2 AMT brackets, 26% and 28%. So for high income earners, that's actually going to be a lower rate than what your income tax would be. Some states also have a state alternative minimum tax, California being one of them. Some states don't have any, AMT, nor do they have any income. Texas, Florida are a couple states, that don't have any income nor AMT. So anyways, be mindful of what your state's rules are. But if you were to exercise options and you were to incur AMT, it most likely would be at the 26% or the 28%, depending upon where your income shakes out for the year, and also how much spread there is on the incentive stock options. So anyways, just wanted to highlight, what are the different types of tax, and then also, show you kind of the range and the magnitude of what these different types of tax, how much you might be paying.
Yeah, just to kind of summarize this page and the takeaway, the name of the game here is get as much value taxed at the lowest rate possible. Because why? Because that means you have more money. Like, duh. Now, how do you do that? Well, income rates and short-term capital gain rates are higher than long-term capital gain rates. So the way you benefit or you take home more of the value is by getting more of the value into the long-term capital gain bucket. That's the whole deal. There's trade-offs along the way. There's risks. There's all sorts of things to consider, but that is what you're trying to do while you balance all those risks and trade-offs. So keep it in mind as we go along and talk about, different taxation and whatnot. The whole name of the game is how do I get more of the value taxed at the lowest rate possible?
So this leads into, okay, if the name of the game is how do I get as much upside and the value taxed at the lowest rate, then why would I consider exercising before the IPO? As John said, there are real risks. Just because an S1 has been filed does not mean that it's a guarantee that there's going to be an IPO. It's very likely, but it's not a guarantee. So anyways, this leads into a 409A valuation. That's a term that I used in the past. And for private companies, 409A is just the valuation for the fair market value that a independent tax party does, and it conducts on what is the business valuation for one share of common stock. Now, 409A valuations are typically going to be lower than the price that investors pay, which is known as the preferred price, for a couple of reasons. One, investors are buying preferred shares or convertible preferred shares, which have some preferences that common stock does not possess. Now, in an IPO scenario, most likely the investors are going to convert their preferred stock into common stock, and there's just going to be one fair market value, and that is going to be the listing price. However, there is some additional protections they have in a not so favorable exit scenario. They would get paid back first before any of the common stockholders would receive anything. And so that's one reason why the 409A valuation is going to be at a discount, most likely, to the preferred price. The other thing is because ServiceTitan is private, it's illiquid, and there is a lack of marketability discount that gets applied to the valuation because you can't log into your Fidelity or your E-Trade account and sell ServiceTitan shares today. So anyways, you get a discount. Now, if ServiceTitan was to go public, that discount factor is going to go away. So presumably the IPO price may be higher than the 409A that is currently. And so again, if the name of the game is get as much upside at a lower rate, and we know that one of the bigger drivers of what would cause AMT for exercising incentive stock options or income tax for exercising non-qualified is going to be how large that spread is between the fair market value and strike price. You want to try to exercise more options while that spread is smaller and get more of the upside starting the clock on the long-term holding period. So anyways, 409A, it's an interchangeable term for fair market values. And then also, if anyone were to go on to an earlier stage startup, these are going to be the earlier or the younger the company is, the larger the discount on the 409A relative to the preferred price is going to be. As the company matures and it goes on to raise subsequent funding rounds, that's when you're going to see that spread narrow a little bit. However, there still could be a meaningful discount while the company is still private, even though I know that I heard from a few other folks that window may be closing soon. So if you do want to take action, this may be something you want to act swiftly on, just so that you have the ability to exercise, while that 409A is still intact.
Yes. Make a plan now. Like it can't you can't act fast enough, honestly. It's coming quickly. From what I understand it, I think the blackout period starts on Monday. don't take that to the bank. I've just heard that, so confirm, but I believe it's very soon. Chris, you want to walk them through kind of how we think about putting together a plan?
Yeah. So as you'll see here, like there's a lot, going on and there's a lot of moving pieces. And I think really what we try to do is kind of construct a plan that aligns with what's important to you. And really kind of makes sense of all these moving pieces. There's all these acronyms when it comes with equity. You probably also have a lot going on, with your family life, with your personal financial situation. Maybe you have student loans, maybe you're trying to move into a new home. Maybe you're hoping to transition, to another job or take some time off. And all those things we want to factor into because they play into your tax situation for the year and for, the future years. They also factor into like the risk and, does it make sense to put money into, or do you have money accessible to exercise your stock options? So what we're going to try to do is really look at, your household income, your career plans, how long do you plan to stay with ServiceTitan? What is your comfort with putting money into the company based on your outlook? What other assets do you own and how concentrated are you? It's not atypical for us to see folks that have 70, 80, 90% of their net worth is comprised in one private company stock. So again, it can be a great opportunity, and this, IPO could really unlock a lot of new financial opportunities for folks that have been at ServiceTitan for a while and haven't been able to tap into the value. That being said, if the IPO price, does not go where you want it to go, that's a real risk factor. And so we want to just make sure that the decisions you're making, you're informed on the front end, and also that we can manage the risk appropriately. So if, whatever happens and if things don't work out as we're hoping, it's not detrimental or ruinous to your broader financial situation. Okay, so once you build the plan, kind of how do you tactically go about exercising your options? So first, exercising your options is just buying shares at your strike price. So you would log into, ShareWorks or to Carter, wherever the shares are held, and then you would link up your bank account and you would transfer the number of options you're exercising, the price of that. Those exercise costs get wired to the company. And in return, you get a stock certificate that would be issued to you that just says, John owns, 10,000 shares of ServiceTitan. Once the company is publicly listed, then it likely will show up the number of shares in your brokerage account. That they may change, where these are held. They may have already done that, but the institution may change, to a place where you could actually sell publicly traded securities. But exercising just means you're, trading your money and you're sending it to the company to issue you stock in the company. And now you're a shareholder. So you may owe some tax if you have any non-qualified stock options. There is going to be some withholding. If you have incentive stock options, the exercise costs are the only thing that's due on the day to exercise. You may still be responsible for taxes, but that's on you. And you would then need to be responsible for paying that either in an estimated tax payment on a quarterly basis, or by paying that, by the tax deadline next year. There's a way to potentially pay a minimal amount that's meeting the IRS safe harbor. That's something that we can help folks with. But figuring out what is going to be the all-in tax cost, buying the shares and the tax implications, and then when do you need to make the payments. But just know if you have ISOs, Carta, Morgan Stanley, is not going to request the taxes be withheld. That's on you to make that payment. Then you own the shares. And then again, you're going to be paying that over the course of, either in quarterly installments. So there's the next one is due in January, or you could be able to pay the remaining balance in April when you come to file. Just want to make sure you have sufficient liquidity, even if, that tax balance is due ahead of the lockup period actually expiring. And so, when we think about kind of building a, exercise plan, but also, thinking about a sales strategy. So maybe you haven't exercised, and that's okay. Maybe we can exercise a little bit before the blackout period starts, or maybe, you don't exercise ahead of the IPO. Or if you have shares already, really thinking about, why kind of when we say thinking about your why, like there's, a multitude of things that you could do. And that this, potential money from your ServiceTitan equity could open up for you. That could facilitate taking some time off work. We we know, working at a startup and building a company, it's a grind, and it can be full of, a lot of really exciting and exhilarating things, and it can also really take a toll. And so some folks we've talked to, they're like, I just need a break. And if I have the financial means to be able to take some time and not be reliant upon a paycheck, I want to do so. Other folks may want to upgrade their house, or they may have some, tuition bills coming up, or maybe they want to launch their own business. Like all those things are on the table. And so we really want to understand, like, what's most important to you? What do you value? And then from there, that's the lens that we would create a sales strategy. We would create a financial plan and really help you to align, the decisions you're making with your ServiceTitan equity with ultimately, how's this facilitating what you want for your life?
Exactly, Chris. And I just want to say, like, working with our clients, this is the most fun part to see after the liquidity event. We've had clients of ours decide to travel the world for a year, and they've sent me postcards from China and Brazil and from all over the place. It's just awesome to see them, living their best lives. The other folks that, or another person's really interested in developing a video game. Now he can, because he's got the financial freedom to pursue that dream. It's just fun to kind of help folks understand what's possible with the money that they now have and help them think through, what they're going to do with that tremendous gift. So this is the best part of the job, in my opinion. Um,
Agreed.
Chris, you want to talk about the plan itself a little bit and what that
Yeah.
means?
Yeah, so we've been talking a lot about equity planning, exercising sales strategy, and our specialty is really helping folks with their equity. But we, as at the beginning when I was talking about building your team, John is an investment advisor. I'm a financial planner. Like that's really, what we focus on. And we just happen to really specialize in the private stock. And, how do you make decisions, with your equity comp in the context of your overall financial picture? So what we try to do is design a financial life plan. So that takes into account all of your assets, that takes into account your whole family picture. That takes into account, what you're hoping to do. So all the things from retirement planning to kids education to do I have an appropriate amount of insurance? Like it's open enrollment season, does a high deductible plan make sense or a PPO? All those things are things that we help folks with. And in addition to your equity, and really it's, how does this equity fit within the overall picture? And so in this graph, you see, a big spike, and that can be the result of, your company going public and being able to realize the value of your equity. And so, some of the things that we really tried to hone in on is, what's it going to take to make work optional? Maybe it's not retirement in the fact that, you quit your job and you never work a day in your life, but maybe it's, transitioning from maybe, a stressful, like intense sales job to maybe a less lucrative, but more fulfilling job. Or maybe that's, again, taking some time out of the workforce, to spend time with your family. But really kind of what do you need to live your life in the way that you want? How do we mitigate taxes as your wealth grows and as you have big income years? Taxes are going to be, a big factor. And really kind of what we think is it's not about, necessarily what you make, but it's about what you keep. And taxes are a big variable in that factor of what you keep and retain. And so by being thoughtful around some tax planning and some tax strategies, there's, some ways you can be able to retain more of your hard-earned equity. And then ultimately kind of, there's a lot of trade-offs involved, and a lot of people we work with, they're at the stage of life where they got competing priorities and they're trying to think, I want to set myself up for retirement, do well. But I also I got some immediate cash needs and I'm thinking about my kids' education, and is a health savings account, really, something that would make sense for me. All those things are going to be things that we take a look at and really kind of mapping out, how much do you put into each bucket? Which ones do we alternate, based off of your tax situation for the year? And in some low income years, are there things that we could be able to do to kind of maximize and take advantage of those? And in high income years, how can we also, be able to defer money or kind of clump as many deductions so that we can reduce your taxable income? So those are all things, alongside of your tax advisor that we really focus on, with clients. It all starts with knowing you, knowing what's important, and then from there, kind of mapping out the roadmap, for using your equity to create the life you want.
Yeah, I like to think about this sometimes. This is where sort of the planning and the investment portfolio come together and impact, what is the success or the expected success rate of your plan. Um, and that's always fun to talk to folks about because what I find is, people talk about like, hey, what's the number that you need to hit to, pursue this or that dream or whatever. This is where we answer that question based on like what it is that you want to achieve, what are reasonable assumptions for returns and correlations and volatility in the future, how do we do appropriate diversification, all of that stuff comes together to work hand in hand with the plan of how you want to use your money to tell you, hey, what is that number? And how likely is it that you can, sail off into the sunset and do whatever you want now? So this part of the process of financial planning is really interesting and fun, I think. So putting together that sales plan, this is just an example. This does not have to be the format that you follow. The thing that I want to drive home is have a plan, because once that stock starts trading, it's going to be anxiety inducing. I guarantee a lot of you are going to be glued to your phones looking at this share price every day, and that's just not a good frame of mind to be making decisions in. You got to think about it before the anxiety, with a clear head, with an objective mind, before you set your sales plan. So what I'm trying to drive home is come up with a plan. This plan here is centered around what are your goals. So like if you absolutely want to buy a house, well, you know how much money you need for that. Set that aside. You know you need some emergency savings. You know you want to fund a 529 for your children. There's various things that you can say, I want to use this money for this purpose for sure. And there's kind of your lower bound on what to sell. And then in this case, I've got kind of a plan that sells more the higher the share price. So I'm assuming, the stock IPOs at 85, which is close to the last preferred share price in the latest round. And under that scenario, if it's below 85 bucks, maybe you sell half your shares. If it's between 85 and 90, maybe you sell a little bit more, and so on and so forth. So the important thing here is that you come up with a plan that is driven by something concrete, and then you actually follow through with it. There's a lot of cognitive biases that we have when it comes to money, and we see it all the time among clients who come into wealth via an IPO. Some of them are very hesitant to sell. Some of them are very eager to sell, and neither are necessarily right. Like it all depends on what you're trying to accomplish. And what I'm trying to drive home is please put together a plan that's reasonable for what your goals are. And that's how it should be driven in pursuit of achieving your financial goals. So kind of to wrap it up here before I open it to further questions, like I mentioned at the top, please go to our website, use the tools, the DIY tools, read the educational content, and you can even book an introduction call with Chris, myself, or someone else from our team to talk more about whether it might be a good fit to use us for financial planning and wealth management going forward. You'll also find details on like the pricing structure and all that on the website. There was a question about that in the Q&A. So check out the website, and we'd be happy to chat with you all about what to do with your shares and with your options. And with that, I'll open it up to further questions from the group. While we wait for some potential questions, oh, we got one. Are forward contracts taxed as ordinary income or long-term capital gains? think we need more
Yeah, I'll
information.
take, I mean, I'll say one, so
Yeah.
we're not tax advisors, so I would say talk to a tax advisor on this. But I would say forward contracts, one, are not available to everyone. There are some net worth and asset minimums that you need to make to even be eligible for them. I think it also becomes upon, have you previously exercised these options and held the shares to be where it's qualifying? Or are these unexercised? Most of the time, a forward contract is not going to be available for unexercised options. You actually have to have the shares in the contract. So I think without knowing your situation, it's tough to read, too much into it. But I think it's dependent upon a lot of factors, and I think that's something definitely to talk with a tax advisor about.
But that's a complicated one. There's not a simple answer, unfortunately. One of the questions that came in was from someone saying that it looks like on their cap table management software that it says that there's 0 exercisable shares today. I said maybe it's because they're not vested yet. Is there any other reason why they may not be able to exercise today?
Not vested. I mean, unless the company has any kind of
Unless there's a
like
blackout. Yeah.
restrictions
Yeah.
going on already. Those would be the two things I think of.
Yeah. We will be, to answer the question on the recording, we'll be sending that out to participants after the fact. Another question, can you describe a cashless exercise? Sounds like you're buying and selling simultaneously without having to fund the buying. Any implications worth noting? Yeah, that's essentially what a cashless exercise is. It's basically, okay, suppose that it's going to cost me $100,000 to exercise my shares and exercise my options, and my shares are worth 500,000. Well, in a cashless exercise and sale, you would exercise all of the options and immediately sell $100,000 worth to pay for the exercise. So that's what a cashless exercise and sale does. The thing to keep in mind, implication on a cashless exercise and sale, is if you exercise and turn around and sell, that you're not going to get long-term capital gains. So that's a trade-off, like you're reducing your risk, but you're getting taxed at a higher rate because you didn't hold the stock for long enough.
Yeah, but you're not having to, transfer any money from your personal, bank
Yeah.
account or anything like that to buy the shares. So it is a lower risk and a more conservative way. Just be mindful that it would be subject to income tax, as opposed to having any kind of long-term capital gains treatment.
Yeah. And just as a reminder, to get long-term capital gain treatment, you have to hold the shares, not just the options, but you have to exercise, get the shares and hold them for more than a year. That's when long-term capital gains kick in. So if ServiceTitan IPOs are in the first quarter, there's a 6-month lockup, you're talking about, bearing risk for another 3 or 4 months after the lockup expires to reach long-term capital gains if you're exercising, today. All right. Any other questions? That's the last of the open ones. I think with that, we can wrap it up. Thank you all for joining us. And like I mentioned, we'll send out the recording, probably look for that tomorrow to hit your inbox. And again, head over to the website. Feel free to email us directly if you'd like. We'd love to talk to you if you're interested in checking this out further. Have a great rest of your afternoon, and congrats again, guys. It's going to be exciting.
Exciting times ahead.
See y'all.